today we know we had the ECB. I'm going to highlight some of the stuff they talked about and kind of, I think there was a couple of interesting interpretations of this. As I think people thought it was bullish early and then they thought it was not so bullish later, and I'll tell you what my take is on that. So let's just go over what happened here first. They lowered the, let's see, they lowered the European deposit rate by, let's see, to minus 0.40. So that is you have to pay money basically to keep your money in the banks there. They lowered the refi rate by 0.05 to 0%. They expanded their QE program by 20 billion euros per month to 80 billion euros. They have new LTROs, that's the refinance that they are doing for their banks to try to alleviate the pain in those banks. So they're, I think that's also going to address some of the energy debt issues. I think that's sort of their backdoor way of handling the Deutsche Banks and the Credit Suisses. Anyway, what the LTROs do basically is they give banks basically free money, and they either encourage it to lend it out for deposits, or they have, of course, have the option of buying higher yielding assets like treasuries. If if they're buying for zero, they can, it's basically an arbitrage situation. And then one little piece of ointment which came out in the fly in the ointment which came out in the press conference was Draghi was a little bit vague, and he said he's not going to lower rates any further. That's a little bit of I am, but I'm not. It's sort of it was a little bit of a flip-flop, so I think the market didn't love that, but I don't think that's really why the market sold off. First of all, the market rallied on this because it was the Draghi bazooka, and he's disappointed so many times, and he's talked a big game, and he finally delivered. The problem is once you shoot the bazooka, is there another bazooka behind it? So I think that a lot of the rally in the market has been anticipating this move, and that's really why it was sort of just a sell the news event. I had typed out in the beginning of the day that I was looking at the market internals, and this really, to me, just seemed like some sell the news and some profit taking. I think it got a little bit more frenzied. What happened today was it started out as a bit of a liquidation break, and then it went further. What was a little crazy was you basically got up to an R3 pre-market, and then you got down to you basically got down to almost, I think did they just touch it? Maybe they missed it by a tick, an S3. So that's a really, really big move. I mean, that's like a 3 standard deviation move up and a 3 standard deviation move down. That's like almost unheard of. So what do we make of today? The interesting part was at the absolute lows today, the worst of the worst. I didn't really think the market seemed as bad as everyone thought it was. I looked at the internals. You had a lot of selling in the ticks, but you didn't really have a complete fall apart in the breadth. I mean, the worst of the day, it was 3-to-1 negative, which of course is bearish. But for like a trending day, you really need like over 5-to-1, in my opinion. 8-to-1, I feel comfortable with a trending day. So I think a lot of people, oops, that isn't good. A lot of people who I think thought today was just the day loaded up short, and then they got their clocks cleaned by the end of the day because they just were looking at price and they weren't looking at the internals, the volume and the breadth, the AD lines, the ticks, of course, were confirming. So the VIX, to me, was interesting today. It started out very weak. You got a break to 17. You had basically got below the 1785, the 1757, which is an important line, and then it kind of rocketed up. We didn't quite get 20, but the VIX did close over 1785. The close on the VIX today was 1805, so that gives you a slight edge to the bears. That's one issue. Furthermore, what else went kind of wrong today? I have a website that I've been using. It's really very, basically just the CME, and they have a probability table of what what the probabilities are like for the Fed, our Fed, not the ECB, but the U.S. Fed, Yellen and co., to hike interest rates. And what has, I think, become a bit of a problem here was that in March, the rate, it's low. There's basically a 0% probability of a rate hike. April, basically the same. It's 20%. But now in June, which was very low, is up to 46% chance of a hike. And by July, it's 51%. And then if you get later on in the year, September it's 62% and 65% in November, and then December is 76%. And I mean, this even goes to February, which is like 77%. But what really, to me, I'm focusing on, and the only ones I can really look at, is this June number. And yes, it's below 50%, but it's getting, a little close to 50%. And we had thought the last few weeks that the Fed might not want to hike rates any further, that they were done for the year. I still think it's possible that they are, but here is the kind of the fly in the ointment. Remember, in my last couple of videos, the last video I did Friday, which was the last Periscope, I talked about the 6 Fed keys. And I talked about what they look at, the jobs, the non-farm payrolls, the GDP, and I always like the Atlanta Fed number. ISMs, both servicing manufacturing, PMI, which is basically another kind of ISM, the durable goods orders, of course the dollar, and then there's the magic factor that I used to say was the sort of the X factor when I said 6 Fed keys. It's really now officially 7 Fed keys because they mentioned market volatility. So now they are openly basically admitting they are ticker watchers. So we know the market has rallied significantly off the lows, as it did the last time the Fed made their policy error with hiking interest rates. So the spiel, I don't want to get into too much of these numbers here because I think it glazes you over a little bit. And we had a hell of a day today, so I don't need to go into each of these numbers individually. But what you do need to know, and this is the theme for all of those readings that I talked about, is that growth is still slowing. We do have some fairly recessionary numbers. The difference now between last week when I talked about it was that the rate of change, meaning the speed at which it's going down, the economy is declining, is slowing. So if you're heading toward a brick wall at 100 miles an hour, now maybe we're going 50 miles an hour. It's still going to be real painful, and you might break a few ribs, and you might be in the hospital, but it's not instant death on impact like it is at 100 miles an hour. So I hope that kind of, I think that kind of describes well of what's going on. So the absolute number is not doing well, but the speed at which we're not doing well is slowing. So that kind of gives the Fed maybe some cover to sit on the sidelines here, but if things slow, reverse or stabilize, then the Fed might get tempted to start raising rates again. I think that's a huge mistake, in my opinion. I think the jobs numbers are bullshit, frankly. I think they're really low quality jobs. I think that, I was trying to resist. I can't resist. I think they're really low quality jobs. It's a lot of part-timing. There's been a lot of offshoring. There's companies hiring people with less hours or part-timing because they want to avoid the Obamacare tax. And you basically have people who should have higher paying jobs doing more menial work, or people who are working a part-time, one full-time. I'm going to throw this number out there, and I know I assure you it's probably a little controversial, but based on all the measures that I've known in terms of economic measures, I believe it to be accurate. We talk about this 4.9, 5.0% unemployment rate, which is, believe it or not, in business school, what they teach as a full employment rate. I keep pulling my mic out here. They teach that to be the full employment rate, 5%. It's a healthy slack in the labor market, so that if new businesses, create themselves or what have you, they have pools of people to hire from. The problem with the numbers now, of course, as we know, or at least I'm going to explain to you, is that people have been unemployed so long that they no longer are looking for jobs, and after a period of time they don't get counted anymore. Also, we've had, because of the weak economy I proposed to you, people are deferring their lives, meaning they're not getting married as early, they're getting married later in life. They're also putting off having children until later on in life. So you have a graying of the population, and you have people who are now what I believe to be structurally unemployed. Let's put a earmark on that for a moment. We're going to circle back to that in a minute, and if I for some reason forget, someone just type it in, the structural unemployment problem. Anyway, so this has made these numbers, I would say, punk. And I propose to you that when you factor in the number of people who are unemployed, which is at the highest since 1977, meaning the participation rate in the labor force, the percentage of Americans working is the lowest in well over 30 years. I mean, 37, 38 years. I mean, it's absolutely incredible. That means to me that this number is suspect, and I think that if you look at the unemployment number and you factor this in, you're really talking about a rate that's probably in the low to mid-teens. At points, it could get up even into the high teens. I don't believe it's there currently. I believe it's probably around, I would argue 13 to 15% is what I believe the real number is. It might even be worse, but that's just sort of my, sort of the eyeballing of it. You know, that's what the number looks like to me. So that is one of the issues. So what else is weighing heavily on the economy? Why are people getting paid these crappy wages? You know, you look at these numbers, the wage growth isn't good, and you see that people are, you know, are working less hours. We have hit a point in our technological development here that a lot of the jobs, particularly in supply chain management, which oddly I could do a whole video on this, has led to countless inventory recessions, has become so efficient that it's been mechanized, mechanical. Think about ordering. Think about this. Just let's talk about it from a consumer point of view. If you want to buy something now, are you more likely to go into a store and buy it, or pick up your iPhone or your Android, pull up the Amazon app and order it immediately? The answer is I believe, is that it's going more online, and that's causing less brick and mortar stores. I was in, after a movie a bunch of months ago, I think it was like a Christmas Eve night type of thing. Nothing was really, not that many places were open, and I went into a Pizzeria Uno, not really the best of food, but that's a whole other story. And at the table, I was greeted by a iPad-like device where I was able to order my food and not even necessarily need to talk to a waiter or a waitress. That is going to become more and more prevalent. Think about ATMs. You used to have to go into the bank and speak to a teller. Now you just go to a machine. That is the future. And I'll tell you what's going to be even crazier is that they're working on robots here, and that's going to be much cheaper. You don't have to pay Obamacare on a robot, on a Terminator. I don't want to even get into the long-term potential dangers of that, which we've all seen in the movie Terminator. But it can cause even further structural unemployment, meaning that in the past, structural unemployment to me, I mean, the definition is that people are no longer equipped to do the jobs. But now the machines, to hire a machine is much cheaper than it is to keep a person. I mean, think of the shelf life of a robot versus a human, and its productive work years and speed and efficiencies and non-unionization. Yeah, RoboCop, exactly. We're in a RoboCop type of a society now. So that to me is a really big problem, and I'll tell you, a lot of people don't realize this, but this is going to, I believe, in the next 10 years, maybe even less, this is going to start hitting the white-collar type of jobs. Look at Wall Street, for example. The New York Stock Exchange, the floor, when I was young and in college, I used to tune in and watch Maria Bartiromo on the floor of the exchange with that little camera, and she was always being pushed around, jockeyed around, and now you turn it on, I mean, they have a TV set on there. It's basically, there's no one down there. It's like a skeleton crew, and that's all because trading has become mechanized. Think about what that's going to do over the course of industries. And is technology now either going to get less advanced or more advanced, and the pace of change, the rate of change of technological advancement is only getting faster and faster, particularly as we have more and more access to internet high speed around the world. So that's just something for food for thought, and that I don't really believe that the employment situation is really ever, and I know that's a really, really strong word, unless there is a new type of an industry that is invented and that I don't know about, and it's very possible. I do believe that the technological revolution is here, and there'll be something new, and people will have some type of employment. But I don't believe it's ever coming back in the way that we know it. It's just not. So that's my take on the problem with the employment issue. Yeah, it's true. Someone just wrote, I believe human beings are being phased out of many jobs. It's true. It really is. It's just the way of progress. And as long as businesses, which they are run for profit, that's just how it's going to be. So we're probably going to have some type of a dramatic. I don't want to get into this here. It's a little depressing, but there's going to have to be some type of an adjustment in the population, in my view, for this. I don't know how that's going to work. Maybe there'll be rules later on about how many kids you can have, and like they do in China, you have to apply for licenses. You might not be able to have X amount of children. I mean, this is way down the road type of stuff. I don't want to get a little too wonky with this, and this is just pure speculation, and I'm starting to sound like I may have smoked something before the broadcast. I assure you I haven't. But that is really where things could go, and that exacerbates our big fiscal problems in the country. Our system here, because we have promised to people a lot of benefits. Unemployment insurance has been one of them. There has been, never before has a society ever planned for its retirement like we have with Social Security. And it's based really on you won't hear this from people, but the truth is it's really based on a pyramid scheme. And as older people get, benefit and start using it, you need more people underneath to start, I guess, filling in that void of the pyramid. And we have a declining birth rate. So what does that mean? It means that these people there's no one left to pay. I've long speculated that the way to fix this problem is to start opening up the immigration policy. And that's really what's been happening. A lot of politicians don't like to talk about it, but that's the dirty secret behind the illegal immigration issue, is that they're using it to kind of fund the pyramid scheme of Social Security. I believe that this is a mistake, of course, and I think that it leads to the ends of society, which is what happened in ancient Rome, and now we're getting really out there. But I believe, going more fiscally and going into renegotiating types of deals. Like, a lot of the politicians here are talking about renegotiating the drug deals. Trump is talking about that. Bernie Sanders is talking about that. Even Hillary Clinton is talking about that. I would fully expect that to happen. And now we've backed ourselves into IBB. How did we get there, you wonder? So IBB, the problem I see in that, and that's a big gauge of the speculative frenzy that had been in the market, was this biotech. And a lot of people think that it's cheap. It's got a low PE multiple. If you pull up a stock, like, I'm just going to pick one of my faves, your fave, my fave, Gilead, it's only trading at a 7.44 PE, but the thing can't get out of its own way. That's crazy cheap, right? Sure, it is, but what it means to me is that there is a potential here for peak earnings, meaning these companies will never make these earnings again. Like, if a drug is $500 or whatever, it's now going to be $30. That's not good for a share price. It's great for society. It's sort of like a tax that it will be coming out of the system, sort of like cheaper gasoline is a tax benefit for the economy. And now, as I talked about the aging population, this will be a boom to baby boomers who are going to be getting sick older and stuff. So I'm just looking at this IBB. It looks like it's like on a second leg of a 3-leg move down. So I'd be really cautious. I would be more of a fan of this the real kind of parabolic, I would say, move took place from the 207.48. A 1.618 Fibonacci extension down of the top range is like 212, so I'd be more interested there. The last, if you look on a weekly, I sometimes when I'm looking big picture on these things, boy, are we big picture today, right? Talking about, a dystopian type of a future. Believe it or not, I took a class in, it was high school or college about I read all about dystopian societies. They're quite depressing. That to me would be an interesting area. Primary trend is like way, way low in like the 130s at the moment. I think 135, but to me it looks like a bit of a topping process. You had a bit of a head and shoulders top, a break, a check back, a break, and now you're below the last break. The flash crash low in that weekly was 284.16. So to me, anything below there is vulnerable. The real breakout was like 275.40, so between 275.40 and 284.16, anything below that narrow band to me is still vulnerable to lower prices. And you have to think, in the next year, is the political rhetoric going to get better or worse for drug companies? You know, it's sort of like oil and tobaccos were whipping posts for politicians in years past, and now it seems to be the drug companies. I don't think there are going to be too many people arguing for higher drug prices. Of course, in the long run, that'll mean that less drugs are made, and it's all a supply-demand issue. There'll be less money spent on R&D, and so on and so forth. But in the meantime, it makes for good political sound bites. I was stunned to hear Hillary Clinton do a TV bit where she names Valiant by name. That, to me, is quite incredible. So that industry, that whole sector is, the stock was under pressure anyway, and she just came out and like made a commercial and was like, Valiant, and I'm going to go after them. Yep, I can't wait to load up on that one. So that's a really big problem for IBB, and that's been a measure of risk. I'll also give you one more on IBB. Why is IBB having so much trouble? Because a lot of people who bought IBB don't really know how to invest in biotech. So what do? They buy the ETF. If they have to sell the ETF when it's going down, ETFs are made up of stocks. So it becomes a vicious cycle. They sell the ETF, ETF selling has a rebalance in the ETF, and that means they have to sell stocks, meaning that once those stocks go down, that pulls the value of the ETF down, more selling in the ETF, settling out, pull more stocks down. It just becomes a vicious circle until you reach an equilibrium point. To me, it doesn't necessarily look like we're there yet. So I would be a little cautious with the IBB. All right, so we did get a little bit sidetracked here with our conversation. I got a little bit maybe too existential on you guys. I don't know if you guys like that kind of stuff or not, that really big, longer-term type of thinking. Although that's really, it's maybe not actionable like tomorrow per se, but I think it's really useful to think about this stuff sometimes. I think a lot of the times that we get involved where we can't see the forest from the trees because we're just looking at, where is the ES in the next 5 minutes, or where is it going to be by the end of the day, or, where are we in this range? And we sort of don't think about the bigger picture of where things are going longer term. So that to me is what's really, I think it's important. I try to think about these things. This is what keeps me up at night. Anyway, so that is that. I'm trying to find the sheet of paper where I just wrote down the topics. I have a bunch of, here we go. So that covers the IBB. So keeping in the theme of risk on, risk off, remember I talked about those LTROs and European banks or other entities buying U.S. Treasuries. So European banks, they don't have FDIC insurance like the U.S. banks do. So what does that mean? It means you're very wealthy, you need a place to store your money so you don't wake up one day and the ATMs are shut off like they were in Greece. If you have a 5,000 or 10,000 euro account, it's a big problem, but if you have a multi-million-dollar situation there, So what do? You need to put it into some type of a safety, someplace safe where you can, one, have a lot of liquidity to get in and out, and two, not move the price up and down on your buying or selling. And the only and most deep market for that ever is the U.S. Treasury market. So that is FDIC insurance, the equivalent, which is just the backing of the full faith of the United States government. It's federally insured. A lot of people were, we'll get into this in a minute with funds with Puerto Rico, but or maybe we won't. We might not necessarily get into that today. I think that's stretching a little bit too far. But we'll say this, that I believe that people have been buying treasuries as sort of like their version of sticking their money in their mattress, except it's not under their mattress, it's in U.S. treasuries. So that's been why the treasuries have been such a strong investment. Yeah, that a lot of people, wealthy people around the world, they stick their money in U.S. treasuries because when things get squirrely, you don't worry so much about a return on your capital as a return of your capital, getting your money back, so to speak. So with regard to treasuries, obviously the probability of interest rate hikes being back on the table caused some issues in treasuries. We kind of had a bit of a spike and we've been pulling back. We are, however, above the 50-day, and I've said that a healthy pullback could be anywhere in the 126s to 127s. We're holding 128, so yeah, it was a little iffy today, but I would say it's still pretty high. I mean, think about this. The end of the world was 2009, and the highest the TLT got was 123.15, and we are well above there. So that shows you there's still, a great demand for U.S. Treasuries. This, of course, is fantastic for the United States, meaning that we can borrow tons and tons of money here and pay very little for it. Of course, longer term, we have a lot of debt, but if it's locked in at a low rate, that is fantastic. And I believe we should be issuing tons of debt to refinance. That might be a little bit controversial, but I believe that we should be doing that. With regard to the dollar, that is one of the things the Fed watches also. It ties in really well with treasuries. It's the deepest and most liquid currency in the world and the deepest and most traded asset class in the world as well. Everyone thinks it's the stock market or bonds, and bonds are second, but it is currency is number one. So the dollar being weak today I think got people a little bit nervous that if the dollar weakens, it takes a little bit of pressure off the Fed. Higher stock market, lower dollar takes pressure off the Fed and allows them to hike interest rates. So that is a bit of a problem. So someone just wrote that the U.S. government doesn't need to refinance. It absolutely does. We need to issue as much debt for as low rate as possible. And I think that you borrow when you can, not when you have to. That's, I'll tell you, that's the mistake a lot of people make, is that they think that they don't need to take money when they can, and when things go badly. Like, think about if Greece had refinanced a long time ago. Anyway, so let's get back to the dollar here. So the issue here is that people got a little nervous today that if the Fed wasn't going to, if that wasn't pressuring the Fed, that maybe that would cause some problems and the Fed would be more inclined to raise interest rates. Could the Fed sneak in a hike? It doesn't seem like they're going to do it in March. My rationale for that is that the Fed futures aren't showing that, and the numbers, the economic numbers, were really weak. It's just they're slowing. The pace of them weakening is slowing. So I think it would be very premature here if the Fed were to make that mistake here and hike rates. So I'd say that the imminence of an immediate hike are very unlikely. If the Fed did that in March, you are probably talking about what happened the last time, another 200 points down in the S&P 500. So if they snuck one in, it might even be worse because the market isn't anticipating it. So if they do something like that, it will be really fugly. And by fugly, I mean effing ugly. So that's the story there. So, as often is, there are inflationary fears here. It's strange because we still sort of have deflation, but We have had a rally, quite a sharp rally in the gold market. We've had these moves before, and they've been met with sellers to make lower lows. I'd be a little careful here. It's quite extended. It's moved really quite significantly. If you're looking to get into gold, my opinion would be is you probably are not as smart money buying it in the 121s as you were in the hundreds. I would be waiting for some type of a pullback. Gold gives you them quite regularly. That is my view on gold. So, what's going on in the market here? I'm just looking at some of the stocks that kind of drive the NASDAQ, and like Apple today, for example, had a lot of strength. I think some of that was their buyback. I'll tell you, as long as Apple holds this like 100 to 172-ish area, the chances of it getting, going lower are greatly diminished. The 20 MA is about to cross through the 50, which is good. The last time when it kind of crossed the wrong way, you had a pretty nasty fall out of bed in Apple. So that's looking better. The 20 is turned up. I'll tell you, in my experience, this was really more pre-split. This was sort of when Apple was in its like beast mode, when it was like up every day a bunch of years ago. As long as Apple back then was above the 20 MA, it was always bullish, and when it was below, it got really iffy. So the 20 MA post-split has not proved to be as useful, but that is something to be mindful of, and the 50 is first starting to level off. So I would say that if you want to play Apple right or right out against 100, knock yourself out. If it can get back up over the 103s, it'll probably see the 107s and 109s. If you lose the 100 convincingly, the risk is that we make a move down back into like, the maybe 97s, 98s, and maybe even 92s. So I'd be a little bit cautious if you start losing 100 in Apple. Google today was also something that had me thinking that the market wasn't going to be a complete disaster. It was strong and basically green all day. It's also over the 20 MA. It had a bit of a look above and fail with the 50, which it did the last time a couple days ago, and it pulled back. But I would keep an eye on today's range. Below is probably more bearish. Above is probably a little bit more bullish. I've discussed that I'm not really so apt to play Google when it's chopping. I like to either buy it at the range extremes, meaning the channel low, and then sort of sell it or short it at the channel high. So that's my thinking with Google. I'm going to end here on S&P 500 because that's really what to me is more important. So where did we end with SPY today in relation to where we're going further? So I always like to say that Fed day ranges, and I guess you could extend that, and I often do extend it to ECB day ranges when they're wide. You can use that range as the importance. So anything below today's low, which was a look below and fail of the 197.86, I would say if you start kissing the canvas then below there, and that would be really below the prior two-day range, and most of today's range, I would be more suspect thinking that we're going lower. However, and I did mention already that the VIX did still close above the 1785, so I would say you have a slight advantage there in terms of the bears. If you can get above today is Thursday, I would say the Tuesday kind of reversal day high, which was 199.92, and I've discussed that the 61.8 on the moving from the high to the low and like the retracement back up was 199.96, so let's just say between 199.96 and 200, I would start saying that the chances of going higher are much more significant. You have a couple of days highs here, in the 201s, and that was today's high, so I would say if you can clear the 201, you probably have a little bit of a chance higher. The problem for me, and I think this is what people were thinking today when they kind of sold the pop, we've had multiple days up. You also had an options roll, which I don't really want to get into too much, but when you have an options roll, that can cause a lot of extreme volatility. But you have a declining 200-day moving average above us just in the 202s. You have an old reference high, which was some support and now could be resistance at the 201.90 to 202 level. And then there's a gap fill, which is basically the 203.87. So I think people got a little nervous that the risk reward for that little bit higher versus a significant move lower. I mean, we were to lose the 197.86, I think we'd see 195 so fast, maybe even 193s and possibly even 191s. That's a big drop from here. So I think that's really what people, basically you'd be giving back almost half of the rally. So I think that's what people were getting a little bit nervous about. So yeah, next week we'll have another Fed day range under our belts. So but until then, I would say we can use this ECB day range. So like I said, above the high of day, I would think that we probably press a little bit higher and would get a likely squeeze. I mean, if you're short, you probably have to use today's high of day as a stop. You can get that run. And then I would say if we get below today's low, granted we closed quite a distance away from it, but I would say if we get below there, it's probably going to be, you'll have a lot of days of topping pressure above you. And I would say that the move then would be a little bit lower. So let's keep an eye on the VIX. If it could get below that 1785, I would feel a little bit more confident that the move is going to be up. If it stubbornly holds, and I discussed in the weekend review video that we're kind of we were, at least at the time of the video, toward the lower end of the range, and I was anticipating a little bit of pullback and some volatility, then I would start being a little bit more iffy. If it's above the 1785, a little more iffy. Below there, I think there's a little bit more room in the range in terms of the rally. With regard to what options are pricing in, a lot of people have opinions, but options really do matter, and today is Thursday. Tomorrow is really not expecting apparently too big of a range. The options are only pricing in $1.50, just below $1.53, so we might lock into some pinning action tomorrow. That would be really frustrating, right? If tomorrow is sort of just another consolidation day, I think that would put a lot of pressure on next week, particularly with the Fed. Next week's expected range is $4.47 about. That to me is a little bit more interesting. That would basically take you up to that gap fill or back down to the levels that I was talking about. So that's really what I'm thinking, that we have to basically play on either side of the ECB day range. So right now I would say that it's a bit of a coin toss, maybe a little bit favoring the bears because of the VIX not quite being below the 1785, and just simply because we're not above that reversal day high from Tuesday, which was the 199.92. So given those two factors, I would say that if you were going to, let's say 50-50 is a coin toss, we're maybe a little bit biased toward maybe going down here. I'd be a little careful. If you can right those two wrongs, so to speak, then the bias to me flips to the upside. It's sort of like playing, here we go, for you guys who love to gamble, it's sort of like playing a roulette table that has a 0 and 00. That's sort of the 0-00 here, to me, is the difference in the odds here. Anyway, let's leave it at that. If you happen to like my video or want to catch more of them or miss this one or want to see it again or only caught part of it, go to my YouTube channel. It's Justin Pulitzer Trades. You can subscribe there. You'll get notifications when I post new videos. And if you're not following me on Twitter, be sure to follow me on Twitter. My handle is @JustinPulitzer. So I'll see you guys on Sunday. It's Thursday, so only a couple more days, and we'll get into some of the more technicals. If you guys leave me some comments on this, either on Twitter or on the stream, like if there's anything on here that you want further expanded upon in the weekend review video, I notice sometimes I get a few comments about something, and then I can address it, which I'd be happy to do for any clarification. If anyone has questions or curious about anything I mentioned here and you want to do it more privately, just feel free to DM me on Twitter. Whether I follow you or not, my DMs are open to, I guess, the public to message me. So give me a little bit of time to respond, and we'll take it from there. Anyway, let's have a good rest of the week, and cheers.